example, you have a $300,000 income here in wholesaling or flipping property or flipping notes income, right? On this side. Then you own multiple rental properties. You buy properties every year because you understand that's going to help you reduce your taxes, and long term, the property is going to appreciate in value anyway. So it's a win-win, right? And these properties on this hand are going to produce losses. So let's just say that every year you're producing losses because of the depreciation component of $300,000. So you have $300,000 losses here, $300,000 in income here. You net the two, you have zero income.
Yeah. So in other words, if you're on your high horse because you own a bunch of notes and you don't own any rentals, this might be time to climb off of the high horse and get your ass into the rental game a little bit, and vice versa. If you're only owning rentals, maybe get yourself into some notes as well. If you don't know that game, you should learn it, because quite frankly, if you're buying a lot of deals, I would say even north of 5 to 10 deals a year, you're probably leaving deals on the table if you don't know how to structure either one, Right. So that's good advice. All right, everybody, welcome to the NoteWorthy USA Podcast. I'm Ben Fredricks, back to host another episode, and today I'm joined by a good friend of mine. But before I bring him on, just a couple of quick housekeeping items. Just remember, number one, our Note Investor Summit is happening February 24th and 25th in Anaheim, California. So if you'd like to come out to that, which I'd highly encourage you to do so, it's going to be highly tactical. Go to noteworthyusa.com/events and get your ticket. Seating for that is extremely limited, so make sure that you do not wait. Also, if you have not subscribed to our newsletter, make sure that you do that. We just got nominated for the best newsletter in the industry, and matter of fact, I think it is the best newsletter in the industry, so you should pick it up at noteworthynewsletter.com. That is a monthly publication that we do that is chock full of content from people in the note space, real estate investors, and somebody like my friend who I have on today. So my guest today is a buddy of mine that I've known for about 8 years now, which is hard to believe, but I'm really proud to see where he's grown in business, and because we kind of cut our teeth together a little bit, in an accounting firm, and I'm proud of him, not only that, but as a human being, because I know when we were first working together that he was going to do some great stuff, and I've seen him along the way, usually by surprise at personal development stuff, and so I'm super excited. He's going to be contributing some content to our newsletter. And so I wanted to bring him on here on the podcast first. So from Advanced Tax Advisors, I'd like to welcome my friend Jose Ramirez. Welcome to the show, buddy.
Excellent. Thank you. I appreciate the intro.
Yeah, man. So, all right. So obviously I know who you are, but let's do a little bit of background for the listeners. Tell us a little bit about yourself and how you've grown your accounting business, who you're servicing, and all that.
Right. So yeah, my name is Jose Ramirez, and I'm the Chief Tax Strategist with Advanced Tax Advisors. As you know, I've been in this field for the past 24 years, been an accountant for 24 years. Well, actually, I like to say I was an accountant for 15 years or 13 years, and then the last 10 years in taxation. So there was a transition in my career, right? I was a financial accountant for many years, working in the private sector and CPA firms and publicly traded companies as a financial controller, financial accountant, senior accountant. And then at one point I said, what's next? And I said, I'm going to transition into taxation because I figured it's the way to go, and it was more interesting. So that's what I've been doing for the past 10 years. And being that I'm a real estate investor as well, I decided to specialize in the real estate industry, which is where we do well, and we were able to help our clients tremendously because of it.
Yeah. So I remember, when you were first part of that accounting group, when we got together, one of the things we talked about was like, all right, who are the group of people that tend to need the most help? And it's either entrepreneurs or real estate investors, right? Like, because things get complex really quick, especially once and I know this just because I own a lot of doors and notes and rentals and, all sorts of different Airbnbs. And,
right.
Once you start dealing with that, I mean, for me in the beginning, I was like working, 24/7, it felt like, just to try and keep up. And at some point, you do need help. So, but I was curious, like how obviously you were doing real estate as an investor yourself, but like, what was the genesis of like, okay, this is how I'm going to niche myself into this particular business?
Yeah, no, that's a great question. I mean, and I actually talk about this on my webinars. The reason I niched down to real estate was because I was a real estate investor, and before I transitioned into taxation, I I didn't prepare my own taxes. I went to a tax advisor to do my taxes, and I had a tax issue in 2012 where, I've been investing for many years, and 2008 came around, and I was upside down in some of my properties. So what I did was I did a deed in lieu of foreclosure in one of my properties, and the bank 1099 me for the loan forgiveness, right?
Yeah.
And even though I had a loss on that property back in 2012, my accountant at the time, when he prepared my taxes, said I was going to owe about $68,000 in taxes, something ridiculous, right?
Yeah.
So he obviously didn't know what he was doing. So I did the research myself. I did the research. I reached out to a colleague of mine and kind of figure out what he was missing that I could fix. And that was kind of the catalyst. That was kind of the transition period. And I said to myself, a lot of people are having these issues. A lot of my buddies that are real estate investors are having the same issues that I'm having. And I can probably help them because I was able to help myself, right? And then from there on, I just, educated myself on the real estate tax area, and it's what we specialize in. We're good at it. We've been doing it for a while. The strategies are great. There's no better industry, in my opinion, for tax savings. The real estate industry offers tremendous opportunities in tax savings because of the depreciation component,
Yeah.
right, on the rentals.
Yeah, absolutely. A lot of our listeners and people that tune into or go to Noteworthy events, a lot of them are note investors. And, there's always this conversation and debate about, what's better? Is it rentals? Is it notes? Well, this is more passive. Well, I get more tax benefits. And,
Right.
So in your opinion, like, is it better to just stick to one particular thing, or can you ultimately diversify like you would if you were in the stock market in terms of what you're holding?
Yeah, no, ideally, and this is what I always preach to my clients, ideally, you want to diversify. You want to have rentals. You want to have an active business within real estate, whether it's wholesaling, notes, flipping property, right? That's what's going to produce your main income, your significant income. Rental property is going to produce income as well, but it's also going to help you reduce your taxable income because of the depreciation component. Most real estate investors, if they're doing this full time, most of them are going to qualify for the real estate professional status, which eliminates any limitations on losses. There's a couple of rules, a couple of tests you got to meet, but if you do meet those tests, any depreciation that you take on your rental properties can be used against your ordinary income. So let's just say, I'll use a simple example. You have a $300,000 income here in wholesaling or flipping property or flipping notes income, right? On this side.
Yeah.
Then you own multiple rental properties. You buy properties every year because you understand that's going to help you reduce your taxes, and long-term, the property is going to appreciate in value anyway. So it's a win-win, right? And these properties on this hand are going to produce losses. So let's just say that every year you're producing losses because of the depreciation component of 300,000. So you have 300,000 losses here, $300,000 and income here. You net the two, you have zero income, right? Of course, I'm simplifying it, but there's some qualification processes and tests that you got to meet.
Yeah. So in other words, if you're on your high horse because you own a bunch of notes and you don't own any rentals, this might be time to climb off of the high horse and get your ass into the rental game a little bit, and vice versa. If you're only owning rentals, maybe get yourself into some notes as well. And, if you don't know that game, you should learn it, because quite frankly, if you're buying a lot of deals, I would say even north of 5 to 10 deals a year, you're probably leaving deals on the table if you don't know how to structure either one,
Right.
So that's good advice. So,
Absolutely.
one thing about taxes, I think you'll agree, because you know it, you do it every single day, is, I mean, let's be honest, it's not the sexiest thing in the world, right? Like, but the thing that we all have to deal with it. It's like death. It's simply unavoidable. We will have to pay taxes. Some people are very good about not, or what do they call that? Tax avoidance, as opposed to I'm not paying any taxes.
Right.
So, one of the reasons I wanted to have you on the show and inside of the content in terms of the newsletter is because of that, because we get asked all the time, like, oh, who do you use for CPA? Like, or what kind of tax planning are you doing? And I mean, look, you ask the normal investor, they don't know from what they know. They're so deep inside of their business trying to, grow a portfolio that they don't really have the time to look at or even try to understand it because it's so complex. And so, I think that's why you want to work with somebody like Jose, is because you need to have somebody that's on your side that is essentially saying, all right, this is the way you're going, but if you keep going this way, this is what's going to happen. But if you make these little tweaks, it could be so much better for you. So can you talk a little bit about like what a tax planning session looks like just from a high level? I know it's different for everybody, but somebody that owns real estate, like what are some of the things that you go over with them to make sure that they're maximizing their benefits?
Yeah, and real estate is going to be the main tax planning strategy is going to be the rentals, right? That's the one that's going to make the most difference. Because if you qualify for the real estate professional status, all those losses that you may have passive that are considered to be passive, now you can elevate them into an unpassive loss and apply them towards your ordinary income.
Yeah.
So, entrepreneurs, business owners, when they're starting out, they don't really understand the tax code. I see a lot of people that are starting out make mistakes, and these mistakes can be avoided just by having a simple conversation with a strategist, with a tax advisor, right? Like having the right entity is important. You may want to operate under an S corp for some businesses, but for others, you may not want to, right? It may not be a good idea. Rental properties should never be put in an S corporation or a C corporation, in my opinion, right? The IRS doesn't like S corporations to have most of their more than 25% of their gross revenues from passive activities. So that's a IRS rule thing, not a Jose thing, right? So you never want to own. There's other reasons, but you never want to own real estate under an S corporation unless you're going to flip it, right? But if it's a long-term rental, you want to own it under an LLC, sole proprietorship, or a partnership. So these are little mistakes that people make all the time, and the issue there becomes that once you own the property under an S corporation, you can't really take it out of the S corporation without having a taxable event, because now you no longer own the property, the corporation does. So a lot of people think, oh, it's my corporation, I can do whatever I want. No, that's not the case. You don't own it anymore. The corporation owns it. So you have to pay capital gains if there's a difference between the fair market value and the purchase price. So those are little, if you remember this in the future, remember not to buy property under an S corp. Little tip there.
Yeah.
But yeah, tax planning is going to be a combination of different strategies, right? It'll be the cost segregation, doing cost segregation analysis on your properties, on your rental properties, to accelerate depreciation and take bonus depreciation, which is at 100% today in 2022, right? That's going to change in 2023. It'll go to 80% bonus depreciation. So that's going to be the biggest one. You got smaller ones like the Augusta rule. You got, medical reimbursement plans that you can do, but the big ones are going to be real estate related.
Let's talk about the depreciation aspect, because it's not something I'm super familiar with. What does that mean when you say 100% bonus depreciation?
Sure. So the IRS or Congress, right? There's these laws that say that you have to depreciate property. You depreciate property, meaning it's an expense, it's a non-out-of-pocket expense that you use as an expense on your tax return and on your books. It doesn't mean the property is going to depreciate, right? It usually doesn't. Maybe if it's a vehicle or other, equipment, property, maybe it does depreciate in real life, but real estate doesn't, right? In real life, real estate appreciates.
Yeah.
But the term depreciation comes from the IRS. So the IRS allows you to depreciate your property if it's a residential property over 27 and a half years. So when you buy a property and you go to the closing, you sign the HUD, the closing statement. The closing statement is going to tell you that you bought a property for, let's say, $375,000, right? But that HUD does not tell you what's included in that $375,000. Like, how much is the roof worth? How much are the walls worth? The refrigerators, appliances, none of that, right? So if you don't have that information, all you know is that you pay $375 for the property. You have to back out the land because the land is not depreciable. It's not an expense that you can take on your tax return. So let's just assume that the land is $100,000. So now you're left with $275. You take that $275, you divide it by 27 and a half years, because that's the timeline the IRS allows you to depreciate residential property for, and you get $10,000 a year, roughly, right?
Yeah.
That's depreciation. That's an expense that you can take every year on your rental property. That's a non-out-of-pocket expense. It doesn't cost you anything. It's just what you do to expense it every year. But if you have a cost segregation study on the property, now you can identify more things within the property. Now you know that your 275 is really made up of 50,000 on the roof, 20,000 in appliances, 15,000 in a fence, right? So if you can identify the components individually with a cost segregation, now you can take those components and the ones that are considered, this is very technical, so stay with me. The ones that are considered that to have a timeline of 20 years or less, things like personal property, refrigerators, kitchen cabinets, countertops, 20 years or less, you can take 100% bonus depreciation the year that you place it in service. That's as of today in 2022, right? Mm-hmm. So meaning that if I can identify out of the 275, I can identify $100,000 in property that is 20 years or less, that $100,000 can be depreciated in 2022, which gives you a huge advantage because now you can reduce your income by 100,000. And in most cases, the tax savings are greater than the money you put into the property. So let's just say you put 5% into the property.
Yeah.
The tax savings are usually greater than that. So it makes sense to always buy property.
And does that come back in the form of like a refund? Like if it, let's say for instance, it blows away like what you have in terms of income because you've got a large portfolio, right? Mm-hmm. If it is that just getting money back immediately from the IRS?
Well, it depends, right? If you paid in your taxes in advance and you end up overpaying, yeah, you'll get a refund.
Okay.
But if you're kind of planning throughout the year and you know you're not going to owe taxes and you haven't paid in taxes because you know you have depreciation you're going to take, yeah, there's no refund, right? You simply don't pay the tax.
Okay.
Because there is no tax liability if you're doing it right.
Yeah. Well, either way sounds good to me. So I've heard cost segregation before on multifamily, but you can do this on single family as well.
Oh yeah, you can do it on single family apartments, condos, townhouses, any kind of real estate.
So if I take that out, right? So let's say I own a portfolio of 50 single family homes, and we do what's that include? Like doing an appraisal on each particular house? You got to go through and do that?
It helps if you have an appraisal. You don't have to have an appraisal, but it helps if the property has an appraisal because you want to identify the land value. So the cost segregation is always done based on the purchase price. Okay. So you take the purchase price and your closing costs and you back out the land value, and that's your depreciable basis, the basis of the property that you can cost segregate.
Okay, got it.
Yeah.
And then if I sell that property in the future after I've taken this 100% bonus depreciation, do I have to pay that back?
Yes. So that's a great question. It's a great point to bring up because some people get hung up on that. If you're a career real estate investor, you shouldn't be worried about that. You're holding that property until you die, right?
Right.
There is no, unless you're getting a ridiculous offer on the property, there's no reason to sell because you can always get a loan out of the property if you need money, right?
Yeah.
When you do sell, you're going to trigger a depreciation recapture. So you're going to have to pay back the depreciation that you took. It's usually at a lower rate, so it still works out to your benefit normally. And then you're also going to miss out on the step up in basis. So let's just say that Ben, you buy a property, you have multiple properties now. Let's say you have a portfolio of $10 million today, right? Whatever the case is.
Yeah.
And we're not going to be here in 50 years, 60 years from now. I don't know how long we're going to live, but we're all going to die someday, right?
Yeah.
So when that day comes, that $10 million portfolio that you may have, guess what? When you die, that portfolio is going to be worth, who knows, 100 million, right? And there's usually a step up in basis on that. So when you die, your basis now becomes 100 million, and your kids will get it at 100 million, and they can start depreciating it at 100 million. Right. Now, depending on the exception that we have, when that happens, right now, the exception is, I think, like 12 million for gift taxes, gift and estate taxes. But that changes with every election, it seems like. You can save a lot of money, that this is how you create generational wealth. Now your daughter will get a portfolio at a much higher basis than you paid for.
Sure. Yeah, the only thing I would challenge you on there in terms of like, there's no reason to sell. Well, sometimes there is, because you might want to step up to the next level of property.
Yeah.
Whereas, and depending on where interest rates are, it might not make sense for you to refinance, and, the cash flow benefit might not be what it was. But like, for instance, right now, I'm in the process of looking to sell 4 turnkey rentals because we want to do a project vacation property project in Honduras. So
right. Yeah.
That's the only way I can get that done, because there's no like lending and, stuff like that. But also I was just thinking from the aspect of like, okay, let's say you want to springboard into multifamily, from single family, which I don't really care one way or the other. I think you've got multifamily when you have 50 houses, whether or not they're in the same building or not, doesn't really matter. But sometimes you do need to springboard into something else. And so what if they did, and I'm getting into the weeds here, so if it's too complex, just say so. But like, if I did something like that and I 1031 exchange into something that's a much higher level deal, is that still a factor with that depreciation?
So a 1031 exchange will defer the taxes. It will defer paying back that depreciation. Okay. So it's a great strategy. So to your point, there's got to be if there's a financial reason. I mean, if you have a reason to sell, sell, right? Yeah. But you got to do the analysis and kind of see if the benefit is going to outweigh paying back those taxes, or if you can 1031 exchange it.
Yeah. Okay. All right. Cool. That's good stuff. So, so I would encourage everybody, like, if you don't know what you have taken in terms of depreciation, we'll put a link in here for Jose. You can schedule a call with him, and he'd be glad to talk with you, I'm sure. So we're coming to the end of the year, right? Quickly, we're recording this at the beginning of December. What's the number one thing people should be looking at, not only for the end of this year, but going into the next year as from a tax preparedness standpoint?
Yeah, I have conversations with my clients usually at the end of the year, like right about now, November and December. And the conversation usually goes like this. Okay, Joe, you're going to owe $70,000 in taxes if you don't buy more real estate. Do you prefer to take that $70,000 and buy more real estate before the year ends, or take that $70,000 and give it to the IRS? The answer is usually, I'm going to buy more real estate before the year ends, right? Yeah. Because then they can reduce their taxes from 70 to maybe 20, right? They're still going to spend the money, but do you want to spend it on yourself, or do you want to spend it on the IRS? So yeah, that's like I said earlier, real estate is the most powerful strategy for tax savings if you qualify for some of the strategies. It's all about planning, right? It's all about planning. You can do a lot with real estate.
Well, it sounds to me like you need to connect me and Joe so I can sell him some real estate before the end of the year. Right. We have competing goals. So, all right, cool, man. Well, so let's talk a little bit about, you and I have delved off into some personal development stuff. Like, we're both in Arte Syndicate. Yes. I completely randomly ran into you at a 10X event, several years ago. Yeah. What's that been like for you in terms of accelerating your business? Because I know from when we first met where you were compared to where you are today. Yeah. And what was the catalyst that made that change for you?
Yeah. Well, thank you for noticing, number one. I learned a lot about, and I can't really identify a moment when it happened, but I started learning more about marketing and, branding, which helped, right? We're in South Florida, so most real estate investors in South Florida knows who we are because we specialize in the real estate industry. So we're known for the real estate guys, right? Like the real estate tax advisors. But yeah, it's a combination of things. I mean, Arte is great. Andy and Ed are phenomenal. The coaching that they offer is great in every sense, business, personal. marketing tips that I've gotten from different conferences. I mean, Grant Cardone was great too. They had a great marketing session with their boot camp. So it's a combination of things, and then you kind of build from it, right? You build little by little.
Yeah.
Like every time I went to a conference, I would get a little nugget, and that nugget was worth everything to me.
Yeah.
I would just take that one thing and go all in on it.
Yeah. To me, watching your growth over the years has come from, if I'm just from the outside looking in, for me, it's one thing that you did was that you made yourself an expert in the space. So you got yourself on stage at the Real Estate Investment Association, and which I'm sure wasn't probably the most comfortable thing for you in the beginning.
Not in the beginning, no.
Yeah.
I struggled in the beginning. I wasn't the best public speaker,
Yeah, you don't have to be, but you know what you're doing in the space, and that's what really matters ultimately at the end of the day. And you kept doing it. And so being on that, that stage and putting yourself out there over and over and over again, it really solidified, I think, where you were able to springboard from, because you made yourself the expert to all those real estate investors. Like going to the meetings on the weekends at the Real Estate Investment Association, like all those things that, we don't necessarily want to do, but you have to when you're growing a business. And, that to me is the one thing I noticed, was that you just were out in front. And you've continued to do that. It's just taken on different layers now, with the social media and everything else you're doing. So, all right. So how do people connect with you if they want to talk more about their tax situation? And by the way, guys, anybody listening to this, I've known Jose for years. Like, he's very, very smart when it comes to this stuff. So a lot of our people are out on the West Coast or in the Northeast, or, are you able to work with people that are out of the state of Florida?
Yeah, we work with people all over the states, all 50 states.
Okay, cool. So how do people reach out to you if they want to chat with you and learn more about their situation?
Well, I would say the best way to get to know us and start work, if you wanted to work with us, is attend our webinars. Because this way you're gonna learn about us. You're gonna learn about the strategies that we use in the real estate space. You're gonna learn about our clients, because we talk about some of our clients and the stories. And then you can make a decision, right? Maybe you can say to yourself, I'm missing out on strategies I didn't know I could be using. Hearing Jose speak, I learned a few things, so maybe I should reach out to him. And at that point, you'll have an opportunity to work with us if you're interested.
Yeah.
So the way you attend our webinars is by registering to advancedtaxadvisors.net/webinar. And there's a registration link. You register and you get notified when the next one is, which the next one is going to be on the 12th, December 12th.
Okay, awesome. Is that the one we're doing?
No, we're doing it separate.
Okay. Yeah. So, just so you know, Jose is going to be doing one exclusively for the Noteworthy Network. So we'll put the link for his webinars that you can attend, and then we'll also put the one that he's going to be doing for us into our show notes, so you can be sure to check that out. So, brother, anything else you want to talk about, or
put it on the chat dimes on? Anything you want, man. I mean, real estate's been good to me. I know real estate's been good to you. So
yeah. Well, talk a little bit about that. I mean, what are you doing in the space? Like, are you doing rentals? Are you doing Airbnb? Like, what's your forte?
Rentals, Airbnb, and I started getting into building a little bit. I moved out of Florida. I mean, I still have property in Florida, but I bought some property in North Carolina, which is up in the mountains, and I was gonna start building this year, but the prices just went crazy, so I put a hold on it. So I'm kind of like on a standstill for now. We'll see what happens, but not overly concerned.
What part?
Banner Elk, North Carolina.
Okay,
Beautiful up there.
Yeah, we have a Airbnb that we use up in Maggie Valley. So
Maggie Valley is great. The first place I ever went to in North Carolina was Maggie Valley. It's like maybe 30 minutes from Banner Elk. Yeah, it's close to Asheville, and you can get around and do all that. So it's an awesome area. So well, we got to get you in the note game, brother. Like, I love what you're doing too. I mean, I've watched your growth as well, man. You're doing great things. want to
I
learn
appreciate it.
what
Yeah.
you do.
Notes are fun. Like, I was just literally before we jumped on this call, I was talking with a guy who was interested in doing one of our acquisitions that we're working on. And, he was like, yeah, I have a bunch of rentals. And he's like, man, they're a lot of work. And I was like, yeah, the big sexy thing on the internet is to say, well, it's all passive, right? And rentals are not passive. Like they're just not. And you can have a good, solid management company, but you're like Pacino and The Godfather. You're getting pulled back in one way or the other. There's just no getting around it.
Yeah.
So,
You're
and
still involved somehow.
yeah, and I don't think I've worked so hard as when, we got into the Airbnb game. Like, man, you want to talk
Yeah.
even less passive. That's a whole other step up. So it's just given me a deeper appreciation for notes. Like, I don't, those take almost none of my time. The initial setup does, but after that, I'm out, and that's the one thing that really attracted me to this particular space. But yeah, like we were saying, I mean, you definitely want to have your finger in each one of those buckets if you can, because there's just great ways when one thing's up, another thing might be down, and all that.
No, it's funny you mentioned that about Airbnb, because I feel the same way. Luckily, I have a partner that handles the Airbnb part of it, because I wouldn't have time, right?
Yeah.
But Airbnb, in fact, offers one of the best tax planning strategies, because you don't have to qualify for the real estate professional status to elevate the passive losses to non-passive losses. All you have to do is to elevate the passive losses to non-passive losses is have the average rentals of your guests be 7 days or less and materially participate in the activity. So if you're participating in the rental activity and your rentals are 7 days or less, there's no limitations on the losses. You can just, whatever losses you have on the Airbnb, you can apply towards your business and reduce your taxable income. So there's some powerful strategies around Airbnb. A lot of times it's worth, doing it just because of that, right? But
yeah, I was actually thinking about that from renting out your primary residence too. Does the IRS give you benefit for that in terms of like doing that for free for a certain period of time?
yeah, so that's where the Augusta rule comes in. If you do it for 14 days or less, then all that income is tax-free. But once you reach the 15th day, all the income is taxable. So
okay,
you kind of have to keep that in mind. So
Okay.
the Augusta rule is great because you can actually rent your home to your business 14 days a year, and that income becomes tax-free income to you, the person, the individual.
Yeah.
And you get the benefit of the expense on the business side. So let's just say that you wanted to hold meetings right, hold a board of directors meetings or a holiday party, whatever, right? Masterminds. If you do it once a month, or you rent your house to your business, let's just say for $1,000.
Yeah.
That's $14,000 a year that you're not paying taxes on, right? And you get to deduct it on your business side. So pretty good strategy.
All right. So for everybody listening that takes advantage of this, you can send me a 20% of that tax savings to my mailbox.
We're having that tip, right?
Yeah, that right there. Especially if if you're a two-person family that are both self-employed, right? Can you both go through that, or is that considered joint?
That's a great question. The Augusta rule strategy, it's a great question. I would have to get back to you on that, but I'm inclined to say that it's on the individual level. So maybe you're filing a joint return, but it only applies 14 days only. If you're separate, maybe. I don't know. Great question though.
Yeah.
Man, you got me.
Think about.
You got me, man.
I knew I might trip you up on something. Just had to try.
All right.
Well, listen, you gave the best possible answer. Don't bullshit something you don't know the answer to. So just say, I'll get back to you. So, hey man, I'm so glad to have you on the show. I'm so glad to see where you've gone so far, and I can't wait to see where you take it next. Like literally, I don't recommend a lot of people just because I just don't. I mean, the people that I do recommend, I've known for quite some time. I know they're good people. I know they're smart. I know they know what's up. So if you're looking for somebody to help you in taxes, and I know people that are listening to this are, because it's literally the number one thing that we get asked at our events is like, who's helping you with your taxes? So, because a lot of people in the note space, they just don't feel like the regular run of the mill, which is kind of a stereotype when you say a CPA, regular run of the mill. I mean, they're all smart people,
Yeah.
but everybody is kind of niched and they know what they know. And
Yeah.
so, a guy that's an expert on doing taxes for a law firm is not the same as a guy that's an expert on doing, taxes for real estate investors.
That's
So,
a great point.
I would encourage you to reach out to Jose. Again, I'll put all his contact info in the show notes here. You can connect with him on Instagram. Is it at Advanced Tax Advisors?
Advanced Tax Advisor would be the firm Instagram,
Yeah.
and if you want to connect with me personally, is Chief Tax Strategist at Chief Tax Strategist.
All right.
Yeah.
Right on. Well, thank you, brother. I appreciate you.
Thank you, man.
And,
Appreciate it.
It's good to
And,
see your face, man.
Yeah, good seeing you as well. We got to get together soon.
Yeah. Hey, man, we're in the same damn state. So anytime you want.
Yeah.
I got to get back to South Florida. I love it down. All right, brother.
Good seeing you.
All right, good to see you.